Jake, talk to us a little bit here about how are the various capital sources different and how do they affect?
Yeah, so we use banks, credit unions, life insurance companies, private debt funds, private equity, government agencies, pension fund, basically any capital provider that's out there, right? And the way that all know which one is a fit for any deal is really trying to understand things from like the equity down, meaning like who are the sponsors, how is this thing put together? I mean, there's a big difference between a deal that's just one guy and he owns everything versus a deal where it's syndicated and it's one general partner. What that comes down to is the difference between like is there recourse available for it, meaning like a personal guarantee, or does it need to be non-recourse? And then a step down from that is really understanding like the strategy of the property, right? Is it a value add deal, or is this just like a stabilized acquisition type of deal? Usually, a value add would be, if you're going into a property and performing some sort of turnaround, either operationally or rehab. Usually, we end up in the private debt fund space. Debt funds tend to be like your shorter term, higher leverage, like easier underwriting type of capital stuff that like banks and depositories don't necessarily like to do. If it's more of a stabilized deal and we're looking for like long term, low fixed rates, we'll end up with either banks, credit unions, or maybe like a Fannie, Freddie, or life insurance company, something like that. So really understanding like